Another triple record close for the broader markets. The Dow, S&P 500, and NASDAQ each posted new highs yesterday. So far this year, the S&P has had 60 closing highs, records, a feat that has only happened 3 other times since 1950, notably 2017, 1995, and 1964. Markets also will focus on the Fed this week. The central bank kicks off its 2-day policy-setting meeting today. Joining us now, Gabriela Santos, a global market strategist at J.P. Morgan Asset Management, and Gunjan Banerjee, market reporter at the Wall Street Journal's Money and Investing teams, now a CNBC contributor. Wow. When did that happen?
Just recently. I believe last week we made it official.
Oh, my God. What a weekend you must have had. I mean, just the celebration probably never ended. Did parties every night?
Every night. I'm very excited.
Well, we're excited, too. So, tapering. I think maybe both you ladies have similar feelings that the market is, would you say, looking past this already, Gabriela?
Completely looking past it. And I think it's a testament to how well Chair Powell and the Fed have prepared investors for this tapering announcement tomorrow. So we expect it to be a snooze, and really the attention is completely on rates and on liftoff. And we've seen such a big move on the short end of the curve. There's been a huge pull forward for the first rate hike. Expectations that it could be as soon as June 2022, and that we can get more than 2 rate hikes next year. We think this is completely overdone. This is a Fed that is reactive, not proactive to inflation, and one that's very much focused on the employment side of the mandate and a more inclusive, broader concept of full employment. So we think this curve flattening has gone way too far. Short end yields need to come down. The long end should steepen gradually as tapering actually occurs. And perhaps Chair Powell will start to push back against some of this mispricing tomorrow during the press conference.
Yeah. Gunjan, you look at just the way the stars are aligning. I mean, without the supply chain disruption and maybe as we come out of the variant, sort of with that cast a pall on certain parts of the economy, obviously. But as we come out of that, the demand seems like it's going to be there, and it's sort of overshadowed by supply chain. So you got really strong demand in the economy. You've got inflation running hot. What are we doing down here at these rates anyway? We should just take it and for what it is and just love it that we got these low rates and all these good things happening. I mean, no wonder stocks are going up.
I mean, that is true. You do have this really favorable backdrop, but I do think that there are competing forces at play. On the one hand, demand is super hot. People are ready to spend. Inflation is stickier than many of us expected. But at the same time, it does seem like growth is cooling somewhat, and kind of this peak growth period is behind us. And then Americans haven't gone back to work at the pace many of us expected. So there are kind of these competing forces at play. And I think all eyes will be on that at this Fed meeting, especially how the Fed is reacting to stickier than expected inflation.
Stickier than expected. So, Gabriela, worker shortage could bring back stagflation. This is by Ron Johnson, the senator. I don't think it's the surf guy, the guy with the surf shops. It's probably. Yeah. It's a senator from Wisconsin. Is sticky the wrong word? Because sticky implies it eventually gets unstuck. Are we in for this for a while?
So I think what we have been seeing is that there's some elements of this increase in inflation that are a bit more structural or stickier in nature. So it's not all transitory, and it's things like rental inflation. It's also higher wages and higher inflation expectations. So we don't think inflation is going to remain at this 5%. It will moderate. But when it settles, it should probably settle at an above 2% rate when all is said and done by the end of next year. But I think what equity investors realize is that that's actually not a bad thing when it comes to earnings growth and the stock market, especially when it's combined with good real economic growth as well. And I think what happened in the month of October is the narrative changed from stagflation to reflation. Yes, we had a deceleration in real growth in the third quarter, but signs are that we're seeing a re-acceleration in the fourth quarter. So overall, this is actually a good backdrop for equities, and that's why you started to see cyclicals start to do better, reopening names, consumer-related names, as well as industrials.
Shepard Smith here. Thanks for watching CNBC on YouTube.